if it's not broke, don't fix it. And so that's one of the problems, I think, is that just because finance isn't broken doesn't mean we can't upgrade it. People are afraid of change. There was a study that was done in 2019 that monkeys are better with change than humans.
Do you think there's a world where some of these smaller tokens get also wrapped in ETFs?
Yes, I do think more will go into them, and we will see more types of ETFs as we see more things tokenized. So it won't just be a cryptocurrency, it will be backed by some other private markets.
What advice would you have for someone thinking of making the jump from either traditional finance or software to Web3?
Do your own research, read articles. CoinDesk has got a lot of articles. There's a lot of people out there writing about different things within the blockchain space. And then network.
Behind the scenes, it was a small group of people that were doing everything.
Welcome back to the GTM podcast. It's your host, Scott Barker.
I want to know how this insane growth actually happened.
One thing we've learned in helping our founders and operators scale their businesses is that cash is one of their most precious resources. Cash flow is really the lifeblood of any business. That's why we partnered with Flex to help companies improve the way they manage their cash flow. Flex is a finance super app built around a credit card with a unique net 60-day term that enables businesses to make an investment today and pay it back 60 days later with 0% interest. If your business growth is constrained by the cash flow you need for inventory, marketing, advertising, or really anything else, Flex could provide you with a really interesting growth lever. We use it here internally at GTM Fund. For more information and to apply now, visit www.flex.one. That's www.flex.one. Hello and welcome back to the GTM podcast. Coming at you from our new office, actually. We just upgraded offices, so it's a little bit chaotic. I won't show you what's in front of me because it's an absolute disaster, but behind is looking okay. But as always, super excited for this conversation today. I am joined by Annelise Osborne. Annelise, welcome to the show.
Thank you, Scott, for having me. I'm super excited to be here. I've listened to your previous episodes, and I'm excited to be a guest.
Amazing. Well, excited to dive right into it. And it's, I know, an exciting time for you. You have this new venture at Kadena, an incredible team you just joined. You have a book coming out next week. And you were just in Austin, I believe, for Consensus doing your first book signing. How was that?
Yes, it was amazing. So Consensus is usually about 20,000 people. It's been in Austin this is the third time in Austin, and now it's shifting up to Toronto. I had the opportunity to speak as a thought leader there. And then my first book signing, which was amazing because it was super flattering that people were in line when I got there. I was told that 60 books, because that's 30 seconds a book for 30 minutes, your hand will be tired. But I brought an extra 15. In 10 minutes, all the books were gone and people were just standing in line. And I had the opportunity to speak to everyone. So what was great is we'll dive into the book, but my thought process was this was to teach people, finance and corporates, about what Web3 and blockchain is and why it's important. But the number of tech people that were actually really interested at some of the big banks for reading this. So because they said they were the tech side and they wanted to understand why they were doing it for finance. And so that was really, really uplifting. But yes, it was a great time in Austin despite being 95 degrees in suits.
Yeah, Texas this time of year can get pretty crazy. But quickly taking a step back, I always love teeing up a bit of a bio for the listeners. So Annelise is currently the Chief Business Officer at Kadena, a layer 1 proof of work blockchain, where she is focused. The mission is upgrading finance. So that's a big, big mission. And you have 20 years of traditional finance and 7 years now in digital assets. Above that, thought leader, board advisor, university lecturer, now an author. And the book is actually called From Hoodies to Suits, Innovating Digital Assets in Traditional Finance. I love the name, by the way. And it does hit shelves next week. We'll put it in the show notes. And also holds an MBA from Columbia Business School and a BA in economics from the College of William and Mary. And it's super cool. I don't know if folks know this, but they should by now. I've actually been an advisor at Kadena for a few years now. And I got to say, you've joined just such an incredibly talented team, and super excited for the impact you're going to have. And I think it was perfect time to have you on this podcast. I think it's a timely chat. Um, most of the time, as listeners know, we're talking about SaaS and growing software as a service companies, but crypto is on the rise again, and it will likely get a lot more eyeballs over the next 12 to 18 months. I do feel like the interest in blockchain technology is tied pretty heavily to the rise and fall of kind of these major cryptocurrencies, like Bitcoin, Ethereum. Is that a good thing or a bad thing for the industry overall? Is this increased attention it gets when these cryptocurrencies are doing well?
There's definitely more attention in bull markets than bear markets from a crypto perspective. And I've really been focused on working with institutions and using blockchain technology as opposed to the crypto market. That said, it's interesting how institutions, even using the technology, get tied to the bull and bear market. So after FTX, which was a crypto fraud, there's been fraud both in the hoodies and the suits, if we use that analogy worlds. But there were a number of institutions that said moratorium on anything to do with blockchain or crypto. And so I think blockchain is the base layer that crypto is built on top of. So it's really the technology that enables cryptocurrencies to be so widespread and use versatile, right? And utility, like there's so much utility associated with that. So, but I do agree that that's the case. More people are paying attention when the numbers rise, but also buy low, sell high, right? The idea of that's a lot of stocks as it is. So, also within within the space, I think there'll be less volatility for some of the larger. With we look at there's an ETFs were just passed for both Bitcoin and Ethereum. So I feel that is the SEC actually recognizing them as an asset class, one. And then there's always a question. Bitcoin has been called not a security. Ethereum, the question, it was still out, but I think it's less likely to be a security if it's being wrapped in an ETF form. But the ETF form is a traditional form. Then you have this new asset class in it, but institutions can buy it, or you and I can buy access, and we can buy it through the accounts we have today. And so with that, it's easier to get in and out of for people that are concerned about regulation in the US, for example. With so much money going in ETFs, most of them are long-term holders. And so I think that will decrease the volatility of some of those currencies, not other currencies. So hedge funds love volatility, up or down, whatever it is. So I think there's, money to be made for them there. But I think from the largest cryptos, I think there will be more price stability because of the ETFs and more institutions coming in with big checks.
That makes sense. Do you think we'll see this continue? Obviously, we started with Bitcoin, Ethereum. Do you think there's a world where, some of these smaller tokens get also wrapped in ETFs, or is that going to be a ways out?
No, I do. I think one step is the recognition of, is it a security or not? And there's something that's kind of that the SEC looks at that was years ago called the Howey test. There's a chapter in my book. I'm not a lawyer, so I am not determining this, but I do. To answer your question, yes, I do think more will go into them, and we will see more types of ETFs as we see more things tokenized. So it won't just be a cryptocurrency; it will be backed by some sort of asset. It could be real estate, it could be private equity, it could be some other smaller private markets. Look at the private markets today. There's public markets, there's half as many public companies as there were at Y2K. And so there's fewer opportunities to invest there, whereas more is private. There are more private companies out there, and tokenization can open up that market from a liquidity perspective, a possible potential liquidity perspective, by tokenizing and allowing people to buy in. If you're buying into something that is a smaller investment, there's not as much liquidity than, say, Apple stock, which has a huge market cap. So I think those are more likely to be put into ETFs as well, because then you can get exposure to the space, whatever that space is. So I do think there will be more types of ETFs. I do think you're going to see multiple other smaller cap cryptos that go into them as well. I'm not a crypto person. I'm really more focused on how do we build bonds and private markets and funds and stable coins for institutions. But that's kind of my 2 cents of where I think this, how crypto ties in with the technology and where it's going.
Yeah. So many different applications. I know actually, funnily enough, when we were starting the fund, we went pretty far down a rabbit hole of what the future of venture could look like if it was tokenized, because it would help with a lot of liquidity. Venture typical time horizon, 7 to 8 years if you're, investing in very early stage companies. And there's definitely something there. And I know there is folks doing it. And I think it will have a big impact on kind of the giving people liquidation preferences and options in the private markets above and beyond. I think a lot of people have fallen out of love of, you get this huge equity options package maybe as a startup employee, but 70% of startups fail, and they all have different time horizons. They do well for a couple of years and then they don't, and you don't actually get to participate in some of the upside when things are doing well if inevitably it doesn't go so well in the end.
But there's a couple also. So 2 points on that. One, I was talking to someone that did real estate projects, and but they were only 5-year holds. But part of they went to the retail investors, and what if the retail investors' life situation changes within that 5 years, and they want the option to trade out? So it's the same thing with a venture fund, right? It's the same. There's a lockup period, and tokenization would allow them to transfer more easily to another investor, and they would be able to liquidate the money that they put in, as opposed to have to hold it for 5, or 7 or 10 years. Another thing with venture, if you look at the ICO market, which is how I ended up invited into the space to regulation ideas of ICOs. And ICOs are initial coin offerings. And initial coin offerings were companies at the idea stage, so similar to like a seed funding round, that went out and issued coins to investors. This was not regulated as well, so there was a lot of fraud. But if you think about the idea behind it, that was really a retail desire globally to invest in venture funding for people that had missed the tech boom. And so that was a huge eye opener for me about how, one, widespread the idea and demand for crypto was, because it was so global. Ideas would go viral, which doesn't happen in finance, because finance, if you're viral, you're going to jail. Like, you don't want your name to be known, right? But just that demand, because it's similar to an IPO is when a company is at maturity and has significant revenue, that it's a lot further along. But the ICO is at the idea stage, so they have no revenue, but there's still that demand to participate. So that was interesting to me from a venture, people wanting more access to a different type of investment that they don't have access to, that they still don't necessarily have access to. But I believe that world will change, and there will be more opportunities for retail investors to invest in private markets and venture and other opportunities.
The idea of the ICO makes so much sense to me. It's just democratizing, access to early stage venture for your average, investor that believes in a team, believes in a project. And, currently we have all these funny regulations where you need to be accredited investor or you need to be a qualified purchaser to participate in some of these asset classes. And I think we're going to see that change over time. And, we have things like crowdfunding, and that's not too dissimilar to like what an ICO kind of offers. So I think we'll see that continue. All right. So traditionally, we talk a lot about growing traditional software companies on this podcast, and there's a fairly standardized playbook now, although it's changing as of recently. A lot of the fundamentals are sort of breaking down. But of the organizations you've been a part of in Web3, how is revenue growth, and how do you think about revenue differently than a traditional maybe finance or software company would?
Sure. So it's not necessarily an easy package to sell. So I've run a broker dealer. I have worked to create a marketplace, and I have worked kind of as an advisor. We had created funds, and we're looking for partnerships. I think innovation is costly and expensive to develop, and who pays for that cost of innovation. So let me step back also. when we talk about Web 2 and Web 3, so the idea of kind of when people Web 2 being the internet, right? Just internet, and it's information oriented. And then we move on, which was not as regulated, didn't call for regulation as much. Um, because it was information and data, which is now looking at being regulated. And now we're dealing with it Web 3 being the internet of value, so to speak. So value being currencies, being securities, and so there's definitely more regulation there. And so when you're creating digital asset securities, as in we're going to use this, we're going to tokenize something. So Aspen St. Regis is a hotel in Aspen that was tokenized 2019, I believe, and that was you could buy shares of the REIT, and that were tokenized. You would also have utility value that you would be upgraded, what have you, if you went. So that was one of the first tokenized projects. If you have a typical security, there's a cost to create that technology in between for the first ones. And so who bears that? The buy side or the sell side? So if you are the buy side, you're a fiduciary responsible for money and risk return. That's difficult. If you're the sell side, uh, you could find cheaper capital somewhere else. And so it's there's a cost to innovation. More so, I think, than SaaS. You've developed a product that someone can use. So here, we're still continuing to develop products. So who can find ways to generate revenue? This is why it's been difficult to keep companies going and keep companies alive, I think. I feel that technology is either the institutions recognize it because the institutions see it as a cost benefit analysis. There's ways to increase revenue and decrease costs. And then the other option is from the technology side. Do you have something that other people don't have? So I do think similar to Web 2, there will be Web 3 companies that actually grow to this similar extent, right? That will come and compete with banks and asset managers. If you look at the top data companies in the world, the number one is IBM, and Amazon and Google are both in there, and that is not their main business, but they're within the top 10 data companies in the world, right? So I do think there are opportunities for people to create revenue in this space. I kind of look at who's found something that no one else has. So you have Coinbase. So Coinbase has done a great, obviously they're an exchange, and they're one of the few, they're the largest exchange, and they're public. I think Fireblocks is a custody solution that's more or less a SaaS product, but built for Web3, and they've created something to sell as well. I think Circle has created a stable coin that's been it's not really working with institutions as much, though it is working with some, but it's also the number 2 stable coin out there, and it's regulated, so it has KYC. Well, it works within regulation, so it has like a know your customer. So I think those are 3 examples of in the Web3 space, which is difficult to generate revenue because there's that cost. Who's going to bear the cost of it. But I do think there's places that people have found opportunities. I will tell you, my first startup, my partner had a broker dealer, and we worked together to launch digital asset securities, ideally to build out servicing, right? To build, like, if we can create all these digital asset securities, we can have fully automated servicing. Because one thing that we can do within blockchain is create smart securities that are fully automated and pay when they need to pay and transfer when they transfer and fulfill things a lot of right now that need a lot of people to look at and read legal documents and figure out if that makes sense. So there's a lot of intermediates in the way. But that cost benefit initially that I brought up was really difficult. Who's going to pay? Is someone going to pay more for less risk? Or is someone going to pay more for money that they don't need to create? And so I do think there are opportunities for that generation of revenue, which are the examples of the 3 companies that I mentioned before. But other than that, I think institutions. So I'll tell you, JP Morgan has spent a lot of money internally on blockchain, despite talking about how awful Bitcoin is, right? Jamie Dimon's been really largely against kind of Bitcoin and cryptos. But meanwhile, he created an internal blockchain, and that they're using to save money. So it's almost a huge system within JP Morgan. They create a JP Morgan coin that transacts. I was told $1 billion a day, but we just had the head of Onyx at Consensus who said up to single digits of billions a day. And they saved over $20 million last year just using their JP Morgan coin on some of those repos, which is obviously a fraction of the $1 trillion a day that they're passing through. So I do think that there's a lot of possible opportunities for the institutions, but from us as a startup, it's really recognizing where can we generate revenue.
No, that makes total sense. And I think in software or Web 2, we had the luxury of kind of passing on the R&D costs of innovation to our customers. We're going to make the product better. There's typically a problem that they recognize, and then you go and solve that and say, we're going to continuously solve that problem better, and we're passing that on to you on a per seat license base, whatever it may be. And I think there's a lot of problems that blockchain is solving that maybe the end user or the customer or the institution doesn't know they need quite yet. So there's like I imagine a lot of resources go into the education portion of kind of a sales funnel or a go-to-market funnel.
Well, to be honest, that's exactly why I wrote the book, was because having worked with both institutions and then people that you just know, everyone sees Bitcoin and blockchain as the same thing. And why does it matter? And people are afraid of change. And so the goal of the book was really, it was a labor of love to get it out there, to work for, to helpfully push adoption in the space. Because it really explains, what this technology is, how great it is. Like the hoodie. So I look at the hoodies as being the technology and entrepreneurs, and the suits as being kind of the regulator, more corporate, a little bit more boring. So I think the innovation really starts with the hoodies. I think it's difficult to generate innovation when you're in a very corporate environment because it's very standard. But I think that everyone needs to work together to make this all happen. But I wrote it with the thought process of like, why should the suits care how great this technology is? But the hoodies have created a $2.6 trillion industry. So that is very impressive without the generally extensive business experience or knowledge that the suits have had. So I think working together, this is going to be really helpful, and understanding why it matters to me. So I want Bob, the finance guy, to understand why he should care about blockchain and why he should be incorporating it, but recognizing, there's different ways I can make money. And there are ways you can make money. It just helps to have huge funds to do that, which I can talk about. When you're talking about go-to-market strategy from startups is actually tough. But kind of if you have money, it's easier to make money. So I think there's, why does it matter to Bob? But then also there's a changing demographic, that there's a changing demand for investments. And I think that's really where this technology really comes into play, because you have generations that were born with a supercomputer in their hand and expect it and are very digital. And they're the ones that are they're going to inherit all of the wealth. And they're already half of the working populations. This is millennial and Gen Z, but we can go deeper in that if you want. But like there's a changing economic force coming too.
Yeah. I feel like all you have to do is be of the Gen Z generation and figure out that you still have to go to your bank and send a wire to send large amounts of money. And if you get the wire details wrong, you're literally just sending money into the ether. And if you've ever done that and tried to track down or figure out where your money went, and the bank just sits there and has no idea. And it's just shocking. It's so archaic.
Once sent US dollars to the UK, and the bank changed it to pounds, and we couldn't get the money back because it was their fault. They knew it was their fault, but at the time it was, almost 2-to-1. So that was a lot of money when I didn't have a lot of money.
Yeah, it's wild. And that's just like one of the very, very basic use cases. Yeah.
5 days to cash a check. Like, that's ridiculous. Who's sitting on that money? Like, if I should be able to put that money to work today, and that's what you can do with this technology. That's what you can do with cryptocurrencies or stable coins, which stable coins are a cryptocurrency that mimic the US dollar, that you can transact immediately. So it's immediately exchanged and there's no float. So that works from a business perspective and a personal perspective, except for the banks don't get to float that for 2 days. So there's, but the banks are coming up against competition. And the banks need to learn to do things like be more digital. So there was There's a study done in the UK, 85% of Gen Z get their financial information from finfluencers. Can you imagine the white-haired guys at these banks and investment firms think like being on TikTok learning about finance? But this is the next generation. So there has to be an understanding and kind of a meeting in the middle. And this technology really offers both sides, I think.
Yeah. It feels like a much needed bridge from the reality. Even also like the fact that if you've ever tried to withdraw or take out large sums of money for different purchases, you realize, oh, I can't actually do that easily. Like that money's not actually just sitting there. You'll have withdrawal limits. It's really crazy when you're like, no, like that's my money and I need it right now. And it's not just sitting there, which is crazy.
Which also, to that point, this technology changes. So if I buy Bitcoin or I stablecoin, or there's over $1 billion of tokenized U.S. Treasuries out there, so I can hold it as a I generate yield, so it's about 5%, say, but I'm holding that in my wallet instead of cash in the bank. If it's cash in the bank can turn around and lend it to somebody else. But if I'm holding it, I can actually now participate in lending it to someone else. So I can be the bank and I can make that spread. So there's a concern for the bank. They need to pay attention, because what if everybody does that, right? What if everybody holds their own money in what if the world turns digital and tokenized, and then I can hold it myself? So I do think the bank is going to have to, and the investment companies as well, work with people so they offering them other services, so they don't do that themselves, because that's a huge revenue line, and that's decreasing. Even if you look at an 80-20 rule, so say 20% of the people, that's still 20% less assets in the bank that then is lent and lent and lent and lent, right? That's a huge change. And in the money that they would have, that you recognize they don't always have because they lend it out. That's why you have limits.
Some of these lending protocols are super cool. You could see a future where you need a mortgage and the banks are going to charge you, 7% or something, but then you almost like put it up for bid on anyone else who's willing to, underwrite that for you. And it would be a competitive market. And someone could be like, oh, I'll do it actually for 4%, with my token of some sort. There's a lot of cool things. All right. So I want to go to some of the main themes of the book, but I want to squeeze in this question before. And we talk a lot about obviously the advancements in AI. And I think, for the last little bit, I think it's kind of overshadowed some blockchain technology, OpenAI and others just doing incredible things over the last 9 to 12 months. But I imagine like every sector, AI, large language models will have a big impact on your space. How do you see AI playing a role in the widespread adoption of digital assets and blockchain?
Okay. I would look at this a couple different ways. First, I would look at it that it's faster to write code using AI, because coders and programmers can put in what they want to do, and then they have to review the code because it's not always right, but it's much faster. And so innovation can happen faster when you have this. This is a tool, right? I look at technology as a tool. I don't think it will ever replace humans, because we still have to trust. We still want to trust each other, even though technology can be a layer of trust. When we decide who we want to work with as like fiduciaries or just as people, you still want to know who you're working with, but it's a fantastic tool. So I think that I think we can innovate faster with this. It takes less time. Think about how much of your day takes less time if you don't have to start from scratch every time, which also decreases fees. Like think of your legal fees. They don't start a new legal document from scratch every time they do a contract, right? So I feel that's one benefit. I also think that AI is really based on data. So if it's good data, then it's better AI. If it's bad data, not very helpful. One thing blockchain will produce, because you'll have all of that data because it's all on chain and it's all there, is better data. So you'll know where the data came from. You'll have more access to it because more will be digital. So I do think they go hand in hand. Now AI came when ChatGPT rolled out. It was already, people could use it and touch it, and they could see what it developed. Whereas blockchain is something we've been talking about for years, and not everybody recognizes, one, what it is, or two, do you really touch it? Now, they might buy Bitcoin, what have you, but as opposed to like, from the security perspective. So I think that's why there's been a lot of recognition of AI and the benefits of AI. But also, there was Google's AI, DeepMind, solved a mathematical problem that we have never been able to solve, an outstanding mathematical problem. And that's the generative AI, right? So that's coming up with new ideas. So I feel there's both, different types, but moving forward, it's thinking about things using pieces and creating something new. But I think with the data that we're coming up with, that just moves all of this forward. So I do think innovation will happen almost at a quicker pace than it did previously.
Yeah. Great points. And yeah, it was brilliant sort of marketing for widespread adoption to release Chat GPT as sort of like this user product that people could go in and ask questions and kind of play around with. Is there a comparison? Like, what's the Chat GPT of blockchain going to be? Was that Bitcoin? People could at least like buy it and kind of like interact with it. Is there a next phase of that? Because it is a brilliant strategy for adoption. It's just getting it in people's hands.
Exactly. And it gets better and better, right? The more people use it, the better it gets, the more data is out there. I kind of look at it as a additional Google. Like if you think about a Google search, you can more or less AI can be almost a Google search with pulling up data and giving you sources and, more general than having to read through each of the articles that it clicks up. From a blockchain perspective, there's so many different use cases in blockchain. But I do think the first one, obviously, Bitcoin was launched, the white paper launched in 2008, and the idea was a peer-to-peer exchange of value. So something that they could use to actually cut out intermediaries in the banks and put more back in people's hands for individuals. If you think about the same time, there was a great financial crisis. Occupy Wall Street was sitting downtown and right near my office. Let's cut out the banks because they're all bad. Which is interesting because this blockchain technology is out, like there's so many ways it can cut costs for banks, which does trickle down, and it makes the cost of lending, to your point, lower. But it also, there's the increasing of funds we didn't talk about as much, which also can, with the tokenization of funds that are out there, like venture capital funds, or it's a lower lift to have more investors taking part. So it's a lower buy-in. So it actually offers opportunities for more people to invest, right? People looking for more alternative asset classes. So it's exciting to see where we're going to go. But I believe that, all this ties together.
It's going to be very cool to see all these things kind of converge. It's going to be a very interesting 12 to 18 months. It's a fun time to be alive. And it's just getting, it's exponential at this point. So it's going to, the rate of change, get very comfortable with change, everyone, because there's going to be a lot coming our way. So I want to shift gears a little bit and talk about some of the main themes of the book. And I know it's really hard to condense, an entire book into a few, bullet points or topics of conversation. But really the overarching theme is, how digital assets and blockchain technology are going to upgrade finance and why. And if you could discuss, some of the call outs from the book, and if you could put it through a lens of, listeners to this audience are founders, they're building tech companies, a lot of executives at those tech companies. Why should some of these things matter to those folks?
I think there's a couple different ways. There's one to look at it from a business perspective, and then there's one to look at it from a personal perspective. And I think it touches both. So first, kind of from the business side, I think it's just important to understand what the technology is and how it differs from Bitcoin, how Bitcoin's built on it, kind of other options that are out there. Honestly, anyone from a treasury, anyone that's holding treasury, everyone's managing both expenses, payments. Every company manages payments, and their own internal collateral management and treasury management. And that, I think, is such a key for what can be offered with crypto stablecoins, different investments, just automatic payments, the rails, cross-border payments. Anyone that has companies in different countries the cross-border payments, you don't have those fees if you're actually using blockchain rails. So I do think there's a lot of applications for startups on up just from that perspective. But one, understanding what crypto is and blockchain is, I think it's important to look at the benefits that can be used. Right now, we have this opportunity to program, in essence, money. Right? We can program securities, we can program money, and that's never been around before. So you could have a bond that fully self pays. Right? You don't have to touch anything. It's decentralized, and it will pay where it needs to pay when it needs to pay. So I think it's definitely a different step. I also think what's important is to look at crypto's been around for 15 years. There's a lot of bad headlines, but let's learn from the mistakes or mishaps. We'll call them mishaps instead of mistakes, right? You can look at, there's been obviously FTX is what everyone's heard of, which was um, in essence it was a fraud situation. But you also, there's been fraud on the suits side as well, as not just the hoodies. Like we have had Bernie Madoff, so who's not the first one to create a fraud situation. So if we look at what we can learn from, the Sam Bankman-Fried situation, I think he was a younger person. He was more of a hoodie and actually made sure that he wore t-shirts because he didn't want to be, that was his thumbprint for more or less. But the idea is if there was a board, there was no board, there was no reporting, there was no checks and balances. So I think that, you have had more hoodies involved and the hoodies and suits work together. I think you're not going to have the negative headlines as much. The amount of fraud from cryptocurrencies is actually totally negligible compared to the frauds in US dollars. I think in US dollars, it's like 2 to 5%. I don't remember the numbers. It's in my book. But it's like a 0.002 or something like that within crypto. So even though crypto has a bad reputation, that's not really what it's all about. Then moving forward, look at all the institutions that are building and why are they building? And some are building, there's a lot of examples for actually saving money, which Figure is a lending company. They had Provenance blockchain and they create a lending company to actually create loans on Provenance blockchain. And they're saving 150 basis points altogether for their deals. They've done securitizations as well. 150 basis points on billions of dollars really adds up. So I feel like there's a lot of efficiencies there. Now that might not be for some of the startup companies or some of the SaaS companies, but it's just recognizing that there's opportunities there. And then switching kind of to the retail side. I think it's important to understand this. Right now, 51% of the wealth is in our hands of retail people, of you and me. 49% globally is now in the hands of companies. And so that's shifted, that there's more money in retail hands. So then if we look at the opportunities to invest, like I mentioned, there's fewer public companies. Right now, there's more alternative investments. The only people that have access to alternative investments right now are the ultra high net, outside of institutions, are the ultra high net worth. But you also have a huge chunk of people there that are obviously interested, but they don't have access to them. So then if we go back to all of these large asset managers, every quarter they'll publish how much they're looking to increase, and say they're looking to increase their AUM 20%, because most of them are all looking to increase their AUMs, which is assets under management, to grow. They keep going to the same small pool of endowments, of insurance companies, of sovereigns, and they're not increasing their allocations by 20%. So how are they going to grow by 20%? Well, then you go back and remember that more money's in retail and no one's touching retail yet. We have to figure out how to get retail to invest and get that money. And so the way to do that is using blockchain technology, because it's more efficient driving through to onboarding, to onboard more people is a heavy lift unless you have technology in place. And so that has been proven out. Jenny Johnson, who's the president and CEO of Franklin Templeton, they have tokenized a few funds, but really the tokenized treasury fund, who has recognized such benefits from the tokenization of the fund that believes all money market funds and all ETFs will be tokenized. So that's one step. But then the next step is really the more alternative investments. If you look at the millennials and Gen Z, half of the wealth almost is in the baby boomers, and that money is going to millennials. So millennials will benefit from what they're calling the great wealth transfer, millennials and Gen Z. And so how do millennials invest? Well, millennials invest differently than, people that are the senior executives generally at a lot of these old companies, right? The old institutions. Institutions have been around for 100 years. That's why we trust them. They've been fiduciaries. But we have to understand, how are we going to hit those millennials and Gen Z as a company, right? You have to offer opportunities. Look at what happened with GameStop and then Dogecoin, right? There wasn't fraud involved, but both of them used social media to increase prices, not increase prices. The value increased through social media groups speaking. And that said, Dogecoin was really Elon Musk oriented. But I feel like that's not the first time that's going to happen. That's going to happen again. And there's so much more of a reliance on social media, which would make me uncomfortable to think about finance on social media, just because I grew up as a suit, really. But we have to understand this next generation, because I think they're really driving the opportunities to invest in venture capital, like an ICO or investing in crypto. More younger people invest in crypto. If you look at Robinhood as well, they have half of their investors. The average age is 31, and 80% are under 35. And Robinhood was what was used on Wall Street Bets and Reddit with the whole GameStop stock situation. So the world is changing. So I go into that as well, and then kind of where I see the world going, which is also a little bit about, I think there'll be digital money. So I think we'll have digital money and digital identities, which will be privacy oriented, protecting our privacy. So we don't have to prove that I'm 21 years old. You don't have to know my address and my weight and my eye color. And so I think that will happen. I think the digital money will happen. PayPal USD has, PayPal, which has 426 million accounts already, are creating stable coins, which you and I can transfer immediately, instantaneously. What else? The idea of the ownership of collateral. My mother does not want to hold her money in her own wallet and then lend it out to other people and be the bank, but some people are going to want to do that. I think there's going to have to be business shifts as well. Well, there's also, I think, autonomous finance, like more automated finance and data, are going to come out of blockchain. And we're looking at the next 2, 5, 10, and 20 years, right? So it's going to take a while for everything to be tokenized, but there'll be a lot more tokenized and real world assets and opportunities for people to invest. The Madge is the Kentucky Derby winner last year, a racehorse. He wasn't tokenized, but he's a security because he was actually fractionalized with crowdfunding and won the Kentucky Derby. But it's interesting that a horse is a security, but a Lego is not a security. So we kind of dive into that. Whereas Legos have performed better over time as an investment, double-digit investment, than the stock market has. I don't know the last couple years because my data's a little bit old for that one. But anyway, there's just different opportunities out there. But I do think the companies are going to have to recognize the changing demographics as they go forward, and this technology. That's a lot kind of across. It's kind of going the theme of the book. Every chapter is like a story in itself. But this is super exciting. It's super interesting to me about how finance is changing. Because if we go back, I actually have one of the first railroad bonds framed on my wall, right? It was different. Finance was very different before. We think about pink slips and fax machines, and then now we have high frequency trading. And this is just a next iteration in that. So I do think we'll be able to invest in more kind of fractionalized investment opportunities. What if I love this video game and I want to invest just in this video game? Or what if I like office buildings in Austin and I want to invest in just office buildings in Austin, but I don't want to buy a whole building, right? You can tailor investments very differently, very different diversity.
Yeah. It's all coming, and it's cool to see happen. One of the things that you called out, which excites me, is like millennials are much more. They invest like in their passions, right? Causes they care about, problems they want to see solved, and from a founder's point of view, it is actually much more beneficial to have 10,000 of your fans and avid users backing your business than it is for venture capital firms who, may or may not be valuable. We all like to say how valuable we are, but not not all of them live up to that promise, versus you could have people that are incredibly passionate behind your company and kind of fuel that fire, which I think is a really exciting and needed change. And one of the other things which I'd love your take on is I think there's also a world where, blockchain technology fundamentally shifts the future of work. I think fractional work is becoming much more commonplace. You see a lot of fractional executives where maybe they'll work at 3 or 4 companies, kind of part-time, and they leverage their skills and knowledge to help those companies. And I think, the biggest part, like, humans want a fair playing field, and you can be integral in the building of a business, but because you're maybe an entry level employee, you don't have a director plus level package, you don't actually reap the rewards as much as you would, even though, let's say, you brought in 6 of the biggest deals that ever, closed. And I do see that, finally, with blockchain technology, you could get paid in proportion to the problems that you actually solve for that business, right? Like, more and more data is being captured through Zoom, everything, online and Slack and everything. And you could actually trace the KPIs of different employees and get like a real-time bonus as soon as you hit certain thresholds and things. And I think that's another piece that's really exciting and a good shift.
Well, we didn't talk about really the being able to trace everything. So there's so much more visible, right? When we all have access to the same data, which I think helps with any sort of valuation. We're getting rid of black boxes, and I think that's going to make a big difference. Not everyone loves that. Some people like black boxes because there's an asymmetry of information. Um, but I agree. I feel like there's a lot of shifts that are happening, not just from a money perspective, but for sure. You're also, digital nomad is so much more normal post COVID, and the fact that we have all this technology and 24/7 markets, 24/7, 365. What we didn't mention, what I hadn't brought up, was there's no banking hours anymore. So with this technology, you can actually trade anytime, right? You don't have to wait that, oh my gosh, if I don't get that transfer in, right? If that wire in by 5 p.m., then I have to wait another day. So I think there's a lot of opportunities. One other thing I didn't bring up is utility. So I think, kind of with the Aspen St. Regis coin, I mentioned that you get upgrades and other things for your investment. Think about Amazon Prime and Amazon stock, right? So this is a utility where you can go out and reach your best customers. You can reach your fans. If you actually, using this technology, it kind of opens that up, similar to the Amazon Prime and Amazon stock. If I own Amazon stock, I benefit when the company does well. If I'm Amazon Prime, I pay to get benefits, but I'm a super user. So wouldn't there be some great way to combine to having your super users being your investors? And that's kind of more of a benefit for both sides. So the company understands how all of the consumers think, and we benefit from the investment perspective if everybody does, if that's the case. So I do think there's different engagement opportunities that technology can bring into.
That's such a cool example. If there's any Amazon execs listening to that, that makes total sense to me. That if you own a certain amount of Amazon stock, you should unlock Amazon Prime benefits, and you can follow that example to all sorts of companies, like unlocking different tiers of benefits through this.
Or ticket holders, right? If you're Taylor Swift and you want to put the money back in your fan, like, or give the accessibility and accountability to your fans for tickets, as opposed to it going through, resellers and all the additional fees, then you're connecting with your fans, and you can offer them additional opportunities by understanding who your fans are.
Yeah, it goes back. We talk quite a bit about this idea about of owned media for software companies, of just like not just relying on these social platforms and traditional advertising. If you can build podcast listeners or distribution channels, you own that audience. And this is a similar thing about cutting out banks or middlemen and going directly to the end user or the customer, which is cool. Well, we probably don't have enough time. We probably should have made this 2 hours, because there's so much to dive in. It's such a meaty topic, and one I'm just genuinely, so interested in, and have been for a long time. But I do want to go to a listener question because we get some great ones, and this one's super relevant. You made this jump, and so the question is, what advice would you have for someone thinking of making the jump from either traditional finance or software to Web3? What should they know? What should they be aware of?
So when I did it, I didn't know much about blockchain, and I was asked about ICO regulation from very energetic lawyers. I did a lot of study. I did a lot at the time of watching YouTube. I talk about social media, but that's where the content was before, is like reading and studying and understanding what it is and understanding how I see how I saw the process flowing. That kind of opened my eyes to it all. So that's what I would say is um, do your own research, do your own read articles. CoinDesk has got a lot of articles. There's a lot of people out there writing about different things within the blockchain space, and then network, because people are still the ones making decisions, building teams, finding, and I really think that makes a difference. Ask people for advice. People are generally very helpful. I think that it's a small enough industry that if there are passions out there, there are meetups out there too, and networking places. There are conferences. Some are more expensive, but there are less expensive meetups in most cities. And it's, finding communities. Really what you're doing is you're kind of expanding your community to a different type of community and finding your work there. I do find a lot of passionate people in the space because we're all in startups. It's not startups. You have to be passionate and you have to be flexible. It's definitely a personality type that you do everything. I don't have there's no one to take out the trash, right? So you take out the trash and you answer the phones and you do all of the fundraising as well. So I feel like there's that spectrum. But to get into the space, I would say two most important, well, three most important things is one, education, read; two, reach out to people, network; and then three, attend kind of conferences and meetups, which is technically networking.
Yeah. Timeless advice for breaking into any category, really. But one thing I love about Web3 and time spent with folks in kind of that category is there's no gatekeeping of information or best practices. Like, people are genuinely wanting to help each other across organizations, across the different categories that exist within Web3, which I think is really cool.
It is. It's definitely a community. So open source is the idea. So people can build off other people's code, but it's definitely a community and cooperation, if that's a word, right? So people cooperating together, even if they're competing. Because that's what we need. There's not a lot of standards in place right now. And there's a questionable regulation in the US, as in people don't know. Things are a little gray. They're not as black and white, which makes it harder for some institutions to build. But people work together because you need that community. You need the interoperability and everyone working together, because the whole goal of this is a fully interconnected system.
If that's not a word, I hope it is now. Cooperation. I like it. I like it. All right. As we sort of wrap up, and this has been incredible. I've learned a ton and have a bunch of great notes. I always ask these last two questions, and they are intentionally vague, so take them wherever you want. What is one widely held belief that executives at technology companies, whether it's Web3 or beyond, believe to be true today that you think is bullshit or no longer serving us?
Well, I would say if it's finance companies, if it's not broke, don't fix it. Right. And so that's one of the problems, I think, is that just because finance isn't broken doesn't mean we can't upgrade it. And I think people are afraid of change. You even mentioned it. There was a study that was done in 2019 that monkeys are better with change than humans. And it's, outside of your comfort zone. So I feel like people need to constantly look, where are we going? Not just where are we today? And that's that's the whole, everything works fine now. We don't need to change. So that is one that I feel is frustrating, because I get that a lot.
That's a good one. And you could probably make a pretty strong argument that finance is broken as well, above and beyond that, in a lot of ways. All right. And then the final question, this is the go-to-market podcast, and people are always looking for silver bullets, things they can copy or try. What's one growth tactic or strategy that's been working for you at Kadena? I know you're just new in this role, but what's working?
Building out a community, I think. One, it's a great group of people that are there. It's very smart people, have built great tech. And we're expanding with me joining into the world of traditional finance, which we haven't before. We've really worked more on the crypto side. And I think the best thing to do is I would like to learn from other people's mistakes. And I would like to find people that are have a similar vision and that I've been in the industry for a while, but I've always been, how do we help? How can we always help other people? But then now it's asking them what they think about us and how they think we can build. And so I feel like building a community of people that are very vested, as we just kind of talked about, it's a network, but it's a community as well. So talking to people, figuring out what they think best practices or what they have learned from the past of what they've done. So I don't have to make mistakes myself. I can learn from other people's mistakes. I'll make enough of my own. But I think that's really the benefit is that, you can't, none of us can do this on our own. Any startup, you can't do it on your own. You need to work with other people. And so finding other smart people to help build and listen to their advice, good or bad, right? It's not always easy. It's not always right, but you can make that determination. But I feel like I'd love to learn from other people's mistakes.
I love it. Well, that's a perfect place to end. Community-led growth has been kind of the red thread throughout my entire career. It's what the fund is built on. It's why we do this podcast, and yeah, it's the name of the game. You build a community, and that distribution advantage you get from the community, the knowledge you get, is just so incredibly valuable. Well, Annelise, thank you so much for the time. That was super, super informative. And I hope that piqued a lot of folks' curiosity. And if you want to dive more into it, of course, go check out the book. We'll make sure we put it in the show notes. Anything else you want to call out before we wrap up? Any hires, any conferences you're going to be at soon?
I have a number of book signings coming up. Conferences, I think I'll be at Web3 in Toronto in August. There's a number of different ones in New York I'll be at in the fall. Speaking at universities, happy to come and speak to your group if you're interested. And happy to talk about the book and happy to talk about blockchain and digital assets. So feel free to reach out. LinkedIn is my best because I'm boring and old school, but yeah, I'd love to connect with you. So Scott, thank you so much. Love the conversation. Always fun to think and share. So thank you for having me.
Of course. We'll have to have you back. And for those listeners, thanks as always for lending us your eardrums. I always say it, but listening is only, part of it. Executing is everything. So hopefully this conversation left you with some things to think about and go execute on. And we'll see you next week.